Welcome back, investors. Today we are talking about a pretty exciting company. They are called Palantir, and of course they belong in that big data landscape. As you can see in this graphic, it can be kind of a crowded industry, but I think they stand out for their business model and some of the interesting things about the way that they're running that company. Of course, I do want to throw in here early, I am always looking for requests and suggestions for companies to analyze moving forward. So if you have a company you're really interested in, especially if it's a little off the beaten path, I definitely want to hear those. So drop those in the comments. And moving forward, if you're not looking so much for the quantitative numbers of the company, because a lot of that's available out there, I have qualitative. I read through the 10K and pick out all of the juicy, interesting things in there. So if you're interested more in that side of things, definitely skip ahead to that part of the video. But either way, I'm going to jump right in. So again, welcome back. And we are talking about Palantir and their current price, somewhere around $17. And of course, that's from the other day. If you're watching this, in 2024 or something like that, these numbers are going to be different. So definitely go check those and make sure the numbers are up to date. They recently IPO'd back in September of 2020. So still a relatively new company. Their price obviously has decreased by about 35%. I found that this is really common for a lot of IPO companies. They come out of the gate, get really high valuation, and a couple years in, most of these companies aren't necessarily always turning a profit, and so that share price will usually dive down pretty deep. But if it's a good business, if they can start growing, become net positive, then before you know it, they will be increasing the share price. But again, it depends on the company. That's not always the case. So do your due diligence. So looking at ISS governance scores, again, I like to look at how the company's being run. You have a 6, 10, 10, 9. 10's the worst, 1's the best. But, for example, the shareholder rights, the company, kind of like SoFi, when I checked that one out last week, I believe, they have kind of that founder model and have the potential for a controllership over the company. So I think that usually lends itself to having a 10 on that score. Either way, not terribly concerned. These scores tend to be higher in newer companies. Profit margin and operating margin are negative. Return on assets, return on equity negative. But we're going to talk about that in a minute because there's been some stuff that's kind of dampened it recently. As far as next 5-year growth, they're projecting 73%. I always take that with a grain of salt, but a lot of people are looking at this company and interested in what it's doing. As far as operating cash flow, levered free cash flow, both nice positive numbers. Price earnings forward is really high, but it's a tech company, and I'd say 75, especially for a newer tech company with high projected growth. 75 is really not unreasonable. As far as the PEG ratio, 1.39, that's a good place to be at. I like to see less than 1, but I'm pretty satisfied with that. As far as price to book, 12.56. I do find that pretty high, especially once you start looking at tangible book value. But that's going to be a little different from price to book, so we'll get into that in a minute. Price to sales, also pretty high. But again, those revenues are growing every year, which we'll see in the profitability section of this video. So not terribly concerning as well. Dividends, no dividends. Several of the companies that I've analyzed that are newer companies, they mention restrictions on being able to pay dividends or certain kind of put qualifications on whether they'll ever be able to. Palantir does not do that. So kind of a positive there that there's a little more openness to that being the case in the future. Insider ownership, relatively high. And then I really like looking at total cash, total debt. So 2.9 billion in cash, only 259 million in debt. So very healthy place there. And moving into working capital, as always, I structure this in about 3 different parts: working capital, capitalization, and profitability. So I want to look at, cash flows, earnings power, then move into, debt structure, equity structure, and then starting to look at the profitability side of things. So, of course, kind of like I mentioned with the quantitative versus qualitative, feel free to skip around in the video if there's something you're more interested in. I don't want to bore you with stuff you already know, right? So, typically the factors on the left-hand column, I color code those typically. I did not necessarily do that here. So, some things that are red are not red flags. Some things that are orange aren't necessarily orange flags. So just take that with what you will. Current ratio, nice steady increase, 17% over 5 years. And I mentioned this before, so I hate to be repeating myself in every video, but, with newly IPO'd companies, especially if it was in 2020, the fact that Seeking Alpha, where I get a lot of my data, because they have 5 years worth of data side by side, they usually have data going back 5 years. And so, probably out of the IPO documentation that's filed with the SEC is where a lot of that data comes from. But nice, solid increase in cash. Part of that probably has to do with more issuance of debt more recently in the last couple of years. So that's going to increase the flow in cash. But either way, lifeblood of the company is cash. So doing well there, holding on to that. Cash generating power ratio, one of my favorite ratios. It utilizes the cash flow statement, looks at how much of the cash coming into the company is from actual operations and not necessarily from investing or financing. If it was an investment or financing company, then yeah, maybe I want to see some more of that. But especially on a company that's generating products and making sales and these kinds of things, I want to see them generating that cash from operations. And so very steady increase there. Started kind of negative 5 years ago, but very positive in the last 2 years. Nice 22% growth just from 2021 to 2022. Very positive there. Operating cash flow ratio, also negative for about 3 years. A bit of a dip from 21 to 22. And operating cash flow ratio is looking at your cash from operations divided by your current liabilities. A little decrease there, but either way, nice and positive. So I'm not going to ding them too much for that. Going into capitalization, their debt to equity, they really had no debt for a long time. And, it's kind of the first thing you notice when you're looking at their balance sheet is they don't necessarily show debt for a long time. However, even still, with a little bit of debt they have, they've decreased that from 37% back in 2019 down to 9.5% in 2022. So regardless how you look at it, nice decreasing debt to equity, equity starting to hold an even higher position. This is pretty typical of IPO companies, right? They're able to leverage a lot of their equity in order to use that to fund the company. But either way, if they can continue to keep debt low, increase their equity and the amount of ownership you have in the company, that's just going to be icing on the cake moving forward. So really like to see less than 100, less than 50 is great on debt to equity. So very phenomenal place for them to be at. Debt to assets also decreased over time, about 26%. So again, great position for them to be in there. Assets to equity, that as well has decreased. It's still pretty high, like 2019. I need to do a double check those numbers at 1,000%. But either way, the last 3 years, 176, 141, 130. I see a lot of companies with 200 or 300% assets to equity. So regardless, they're in a positive place. I'm satisfied with those numbers. 14% decrease. So definitely impressed with this. Tangible book value per share. Again, I have this one flagged red. It's actually a green flag. Yes, they had negative tangible book value in 18 and 19. But from 2020 to 2022, you have almost 13% increase in their tangible book value per share. So very impressive there. Obviously, price to book is pretty high, but they have a positive tangible book value, which you don't see in a lot of companies. Even well-established companies don't always have positive tangible book value per share. So that's really positive. And a lot of established tech companies don't always have a lot of tangible assets. So good place to be at there. Looking at total debt, again, bringing in some stuff. And now if you look at long-term debt, for several years it is zero. So you may be questioning, okay, why is their debt showing up? Well, I'm looking at total debt, not just long-term debt. That's going to factor in some things on the current asset side. It might factor in revolving lines of credit. And so, yes, we're going to show amounts there. But in terms of long-term debt, very little to no debt for a long time for this company. So great place to be out there. But they, regardless, in total debt, they have decreased it, especially after the last 3 years, by about 11%. So great position there. And again, 2019 to 2022 is negative 11%. Going from 2020 to 2022, you're looking at almost 50% decrease. Capital expenditure, that has increased by about 21% over the last 5 years. But regardless, you like to see a company reinvesting, especially since they're not paying dividends. They're putting that money back into the company. It's not washing out trying to pay down debt. It's not washing out in other places where the company might be bleeding. Instead, they're able to put it back in the company, continue to reinvest. And so looking into profitability, earnings per share, again, not a red flag. It is negative, but it's increasing, not increasing to the negative, but increasing towards the positive. A lot of analysts have pointed out we expect Palantir to be positive earnings even within possibly the next year by 2024. So great position there. I hope they are positive. I'm not usually this optimistic, I guess, about newer companies. I try not to be too negative. I think I did come off pretty negative, like when I looked at IDEX. There's a lot of problems there, right? And so the more red flags I pick up, probably the more negative I'm going to be. But when I'm seeing positive things like this, I do tend to be a little more favorable in the way that I analyze it. So, and I came in really skeptical. Again, I'm always skeptical of tech companies. I'm always skeptical of, big promises from certain companies. But I really do like a lot of the things that I'm seeing with Palantir. And that's kind of why I've had the tone that I've had. So definitely understand that. I think there's a lot of interesting things and some exciting things on the horizon for them. As far as revenues, increase of 26.2% over the last 5 years. That's great. They're bringing in more cash. They're securing more contracts. That's good stuff. Increase of 28% in gross profit. That tells me that not only are they increasing the revenues, but they're starting to try to decrease some of the cost of those revenues. So in order to get that gross profit up, again, got to at least increase your revenues, but they're cutting some of their expenses. So I really like to see the gross profit increase exceed the revenue increase. As far as operating margin, it's negative. I pointed that out pretty early on. However, it is less and less negative. So, of course, we want to get that to a really positive place. I'd love to see, 50, 60%. But, realistically, if it can get up to, say, 15%, I would be very satisfied with that. As far as return on equity, also negative, but moving quickly in the right direction. So I think that, as long as they can keep that equity high, keep that as the means in which money's flowing into the company, then I think that, we can see that continue to increase and then continue to get a return on that. Now, going into this qualitative section, again, if you skipped the quantitative, you're jumping in here, then, I have some interest in this company because of the things that I've read in their 10K, because of the nature of the business. There are some things we want to look out for, and obviously I'm going to touch on those, but some interesting things for sure. So if you don't know a lot about Palantir, they are primarily a software company. They have three principal software platforms. They have Gotham, which is probably the most well-known. They have Foundry, and they have Apollo. Gotham and Foundry, they're vertically integrated with one another. They transform massive amounts of information into integrated data assets that reflect operations. Now, that's not necessarily for their own stuff, that's for other clients. You have all of these government agencies, you have commercial agencies that really need a lot of information. They need it processed quickly, and these softwares enable them to do that and to do it well so they can make decisions. Now, of course, Gotham, it's used primarily by defense agencies, the intelligence community, but it's also used by disaster relief organizations, those kinds of things. So, a lot of people really focus on, defense or policing, those kinds of things. And so there is kind of a boogeyman aspect to what they do, and that could definitely hurt them if people try to spin it the wrong way. However, things like disaster relief, the fact that they can bring in all this data, enable organizations to sift through that and make good quality decisions based off of that, then, I really see a lot of value in that. Of course, Foundry, it's a central operating system for individual institutions and other entire industries. I'll touch on that. But again, integrated with Gotham enables an organization to basically run everything, their operating system, via their products. And then Apollo, the third platform, it's a cloud agnostic single control layer, which is a bit more techie than I understand, but it coordinates ongoing delivery of new features, security updates, configurations, and it helps maintain continuous operations of their critical systems in virtually any environment. And so basically allows these robust platforms to function no matter where this company is operating at, which I think is one of the things that makes it so valuable. Now, they have 367 customers. They operate in 60 countries. 56% of their customers are government contracts. 44% are commercial, so nice and even split there. 61% of their customers are in the U.S. 39% are abroad. I believe there's a relatively high percentage of that's just in the UK. And that was in the 10K. I just forgot to write it down. And then their average revenue per customer is about $49.5 million. So definitely a small pool of customers. I think I have a note about that. So if they were to lose even one customer, it would really negatively impact the company. So that is one of the warning things that I kind of would throw out there as a hesitation. You certainly want a company, you don't want it on massive consumer discretion, right? Because sentiment shifts and then all those tiny sales add up, but you also don't want it concentrated to too few customers, because if a competitor can come along and take even one, that can really throw off your operation. So something to consider there. But, one of the examples they threw out there in the 10K was they had worked with Airbus and was just trying to help them with logistics with one type of plane. But in working with Airbus, they created something called Skywise. It's an aviation platform for designing, manufacturing, servicing, operating, and maintaining global fleets. And it's now used in a lot of the airline industry. So, a company that's very agile to, again, you think Palantir, you think Gotham, you think defense agencies, the intelligence community, but they are innovating in whatever industry they can put themselves in. They're getting a foothold and they're expanding their business. So very encouraging there. They're also used in healthcare organizations, shipping and logistics, cross-sharing between government organizations, and that's been a historically challenging task in itself, right? When government organizations try to talk to each other, you have layers of bureaucracy, and that's always hindered the ability for the government to necessarily be efficient. So they're doing a really good service to us there, and to shareholders in the company. But I added that to say, look, they are involved in so many different industries, and I think that's what makes the company strong, is just the diversification of where they're serving. They're not limited to just one place. So even though they have a finite number of customers, they are broadly serving different kinds of clientele. Their sales and marketing is built around conversation, so word of mouth, and delivery of strong results. So they're focused on delivering the results for their clients and using that to speak for itself. And obviously it has been working. And part of that, I think, has to do with the types of clients they seek, which I have in this next bullet. They seek out clients who are vendor risk averse due to a lack of working solutions in the past, and clients that are smaller tech companies who can't compete for complex, large-scale opportunities because the install costs and risks of failure are too high, which create too long of cycles for sales. So they use that word of mouth, they deliver results, and they focus on clients that other competitors see as less likely to make a sale, so they don't spend too much time pursuing them. They're trying to find the low-hanging fruit. Well, Palantir is saying, hey, let's go after the customers that have had problems in the past, fix their problems. Now you've got a very strong client-vendor relationship, and I think, again, that marketing strategy is very valuable. Now, they have accelerated customer acquisition, and that's done through expansion of access to platforms, direct sales force, sector and industry platforms, U.S. government requirements to consider commercial options before building their own systems, channel sales, cloud partnerships, joint ventures, and new business partnerships with account growth. So I'm not going to go into each and every piece of that, but they are focusing on a ton of core areas for accelerating acquisition of customers. I really valued the principles of the company. So they focus on privacy by design systems, decisions affecting individual rights to freedom, opportunity, and happiness cannot be left solely to computers. Systems facilitating accountability and oversight are built in, and technology is not the answer to every problem. And so I think a lot of people look at Palantir and they think the opposite of these things. They're trying to pull all of your private stuff out. They're trying to infringe on your freedoms, your liberties. They just want to leave everything up to computers. Technology is just the answer to the problem. And that's not the case, right? They are part of this AI focus, but I think that their principles, if they're living up to those, are going to lead them in the right direction. And of course, I put in here, they have the risk of what I call the Shia LaBeouf eagle eye syndrome. It's that fear around AI, predictive systems, things that overtly almost attack human freedom. If you've ever seen that movie, it's interesting, right? And so I think a lot of people fear that as kind of the boogeyman. Well, I don't think Palantir, again, if they're living up to their principles, they're actually living out those things in the way they design their products, and their clients are utilizing them. I don't think that's going to be the case. Of course, one of the kind of downsides is they have a very strong reliance on AWS. That's Amazon Web Services. They rely on Microsoft and other third parties to support a lot of their clients. So, I hate to see companies that rely too much on third parties. But honestly, almost every company has some level of reliance on AWS, Microsoft, and third parties to support customers. And that's pretty much in any industry. Of course, their contracts with government classified programs can limit investor insights into portions of the business. They recognize that as a risk. And that's something to know as an investor, is you may not be getting the full picture, and that has to do with the nature of their business. Of course, not paying their dividends isn't due to specific restrictions. It's a conscious decision to retain earnings and reinvest them into company growth. Of course, they say that in the 10K, but when you go and look at the numbers, they are in fact doing that. So there is a degree of transparency and honesty here that, again, I really appreciate from this company. Their total remaining deal value, this has to do with contract options that allow for terminations. So basically they create a contract with a company. They recognize the value of that. However, there are these options for termination, and they try to factor those into their financials. They're currently sitting at about $3.7 billion of total remaining deal value that is subject to termination. So something to consider there when you're looking at the numbers. That, in my mind, is a contingent liability. I want to make sure that their cash flows and everything else can cover that $3.7 billion if that doesn't end up coming in as revenues. Of course, they had a decrease in net cash 2021 to 2022, but they note that it was primarily driven by timing of payments to vendors and timing of receipt of payments from customers. So they were able to qualify that well, and hopefully we don't see that increasing over time. If we see that decreasing, if it's right back on track, then we know they were being transparent and honest. The critical audit matters had to do with revenue recognition. Palantir notes, we recognize revenue upon the transfer of promised goods or services to customers in an amount that reflects the consideration to which we expect to be entitled in exchange for purchased goods or services. So they recognize it when they've delivered the product. However, it's not necessarily when they receive the payment. So something to consider there is how the company is recognizing their revenue. So, this combination between total remaining deal value and the way they recognize their revenue, it could be problematic. So, definitely don't want to, cry wolf, but how a company recognizes their revenue is important. This is why you need to dig into the notes to the financial statements, because that's where I found that. That's not necessarily in the management discussion and analysis or right there at the beginning of the 10K. It's in the detailed notes that a lot of people will skip. They also consider the $38.6 million in advertising expenses immaterial, so they don't necessarily report that too highly. I found it interesting, these next couple points. They have investment agreements that have led to them purchasing shares and investments in special acquisition companies, private companies, and the names of these companies are Fast Radius, Energy Volt, Tritium, Rigetti, Allego, Starry Group Holdings, and Rubicon Technologies. Apologize if I pronounce those wrong, but those total $124.5 million. I don't know a lot about those companies. That's something you definitely want to research to determine if those were good investments for Palantir to make. However, they do note that if need be, they can pull those investments out. So they're not totally locked in there, but those are liabilities. This one really surprised me. I've not seen anything really like this from too many companies. They know I believe it's in the notes. Again, things people skip over, but if you don't read the notes to the financial statements, you wouldn't know that Palantir has $50.9 million in 100-ounce gold bars that are stored somewhere in a facility in the northeastern U.S. Again, that's pretty unusual to me, but, the company has invested in physical gold. That's maybe not a bad idea. It could be a challenge, of course, if they have to liquidate that. That's not really a liquid asset, but it will retain its value. So just interesting. I don't really ever see that when I'm reading through a 10K that companies have done that, but I don't know the full story behind why they would do that, but just really interesting. That's why I put it in. And then their intangible assets listed out were customer relationships, reacquired rights, backlog, and other. Most of these had a pretty short life, except customer relationships. So not too many questionable intangible assets or anything like that. And then another really positive note was they had $0 in level 3 investments. There's typically 3 levels of investments that companies have to determine what the fair value of them is. And level 3 are what's called indiscernible valued items. And so like banks, especially with weird securities they create, end up with a lot of level 3 investments. So the fact they have $0 really is beneficial to me as an investor, because I don't have to sit and question too much the actual value of those investments and how well the company did in representing that in the financials. So that pretty much ends it. I really appreciate you watching. I hope you've made it this far. Again, I'm looking for requests, especially if you have companies that are off the beaten path. And, as always, like, subscribe, comment if I mess something up, if you got questions, if, you just want to give me a pat on the back or say, hey, you did a horrible job. I'm looking always for constructive feedback. I want to get better. I want to provide the right information. And honestly, I just like making these. I'm literally just sitting in my car at lunch, recording this for you guys. It's nothing fancy, but I love putting these together, even if it's just for myself, right? And so I hope to see you guys next time. Let me know what you think. And, as always, like, comment, subscribe, dig in, invest well, and I will see you next time.